No, we need an off ramp, right? And this is treated as that off ramp where we take a portion of assets and say we need to really retain these and protect these so that they can provide income in the early years of retirement. So that assets that are continuing to grow that may experience volatility have time to rebuild and continue to grow, right? The average 9% return of S&P doesn't mean it's 9% every year. It just means that the average over time equals 9%, right?
Yeah, if it was 9% every year, it'd be quite easy to develop a retirement income plan, right? Get 9%, and as long as you spend some number under 9%, you're in good shape. But the
Right.
problem is that if you're spending 7% of your money and the stock market goes down 20%, now you're burning the candle at both ends. And that's going to cause you to deplete your account balances a lot quicker. And so, when we think about building a retirement income distribution plan, when we think about taking this pile of money and creating cash flow, there's three ways you can do it. And there's only three ways you can do it. And not every way is right for every single person. It depends on what type of retirement you want. The first way is the conventional way I think a lot of people have historically thought about retirement, which is they live off of the yield of their portfolio. So let's say I have $1 million of retirement assets. I don't want to see my $1 million get eaten into. I just want to live off of the gains. And so let's say that my portfolio can generate 3.5% per year of dividends and interest. Well, that tells me I could live off of $35,000 from that $1 million portfolio. Now, the reality of it is most people don't have enough money saved up to be able to just live on dividends and interest, right? Like for somebody that is amassed $1 million of retirement assets, 35 grand might not be enough. Now, you could make the argument that in some years, there's also going to be capital appreciation. So if the interest or the income off of that portfolio is 3.5%, well, maybe the market goes up another 5% and you can peel off some capital gains too. But as we all know, when you're invested in things like stocks, they are going to generally kick off dividend income. Hopefully, there's going to be capital appreciation. But what else could happen in any given year to that stock portfolio?
It could go down.
They could go down, right? And
It can lose
again,
value.
it can lose value. And so there's no guarantees that we can pull off capital appreciation. And I know for a lot of our clients, and David, I know, we've talked about this in many meetings with clients, is they don't want to have to sacrifice their lifestyle in any given year just because the stock market is down.